You may be wondering, how are mortgage rates decided? Well, obviously you want to make sure you get the lowest possible rate for your situation, but how are they determined? So let's dive into that to see how you can make sure you get the best low rate for your situation. My name is Kevin Brierton, Certified Mortgage Planning Specialist here at Neal Home Loans and the Kevin Brierton team. I'm going to share with you how mortgage rates work. So let's unpack this a little bit. There are several outside factors that affect mortgage rates and how they're determined today, but you can only control one aspect of your mortgage rate. That is your own personal factors. Lenders look at other qualifying factors to determine your risk level, and the better your qualifying factors are, the better interest rate you'll be able to get in return. Interest rates, mortgage rates specifically, begin with the current market rates. You may be wondering how the market rate affect the interest rates and how the overall global economy affects the interest rates. Well, mortgage rates are affected by the overall economy, what's happening in the stock market and the bond market. When the economic outlook is good, rates tend to increase. When rates fall, that's typically not so great for the economy, but it's great for interest rates. Now, mortgage rates are determined by elements that include inflation rates, jobs, pace, and creation, whether the economy is growing or shrinking. When the economy is doing well, borrowers can afford more money, and they can generally, we're going to see higher interest rates in a stronger economy. Now, the Federal Reserve doesn't set mortgage rates, but it does impact the mortgage rates indirectly. The Federal Reserve actually controls the short-term interest rates by increasing them or decreasing them based on the state of the economy. While mortgage rates aren't directly tied to the Federal Reserve rate, when the Federal Reserve changes rates, the prime rate of the mortgage usually follows suit shortly after. Sometimes it actually happens ahead of time if they're predicting a drop in possible federal funds interest rates. Now, the Federal Fund Reserve actually controls short-term interest rates and the money supply that's attached to that. If the economy is struggling, and let's say, in the COVID days or out of the COVID days, based on higher inflation, now to reduce inflation, they can use this mechanism to raise rates up or down depending on what's going on and how much they want people to lend and how much they want banks to be lending out and how much they want to incentivize people to borrow money. So this is a mechanism that could be used to flex that up or down. So when the Fed decides they want to tighten up the money supply, they raise the Fed funds rate. While this doesn't directly increase mortgage rates, eventually banks and lenders must follow suit to keep up with borrowing costs from the Fed. So which personal factors affect the mortgage rates the most? You certainly can't control the economy, the macroeconomy factors of mortgage rates, but you can most definitely control your personal factors. So let's dive into that and help you understand what you can do to control your situation to help you get the best rate. Credit score is a big one. So a high credit score means that you're less risky to lenders. A higher credit score means you pay your bills on time, you don't overextend yourself. When lenders pull credit, it's kind of their responsibility as a lender to review this, but what they're looking for is to make sure that you have a low default risk. Now, credit score isn't the full picture, but it's going to give the lender your scorecard based on your grade and what you've done in the past. So you really want that grade as high as possible. It's going to help you get the better interest rate and show that you're less risky. When you have a lower credit score, though, lenders often charge more interest, sometimes significantly more, or other fees because you're a higher risk of default of getting that mortgage and getting into trouble with that mortgage down the road. A lower credit score indicates you may not pay your bills on time, or maybe you overextend yourself. So you really want to show you have good, strong credit over time. Now, credit score you need really depends on the situation. So kind of general averages, conventional loans, you generally need about a 620 credit score or higher. Most jumbo loans, you're going to be at least 620 or above for jumbo loans. And if you choose FHA financing or VA financing or USDA financing, you'll generally need at least a 580 credit score with most lenders. Now, I will tell you, if you're looking for a down payment assistance loan, you'll need a little bit higher credit score to qualify for most of those programs. So keep that in mind as well. So taking steps to check and improve your credit score to make sure you're in the best possible situation to get the best rate is really important. The next factor in your control is your down payment. So lenders want to know that you're invested really into the house. If you don't have 100% of the funds, obviously not everybody has cash for it. Just think about the more you put down, the less risk you are. Now, you don't have to put down that much. There's some great low down programs out there. But keep in mind, if you put less than 20% down in the house, the mortgage rates generally will increase. Now, it's a little counterintuitive because there's actually times when you actually put down less money and you have what's called mortgage insurance. So that mortgage insurance actually lowers the risk for lenders, and you might actually get a better interest rate by putting less down because you have the mortgage insurance. So make sure you don't have a blanket policy of always putting 20% down, because sometimes putting less down and keeping more in your pocket, making sure you have money for reserves, that's going to be extremely important. And again, counterintuitive, just because you're putting 20% down doesn't mean you're actually going to get the best interest rate. So make sure you review those numbers, because you might be able to get a better interest rate if you put a little less down than 20%. Again, counterintuitive. Because of that mortgage insurance, you may have the mortgage insurance in there, but for conventional loans, you can drop that off once you hit the loan to value of 20%. So even if you put down 10% and your equity percentage grows over time, on conventional loans, you can get rid of the mortgage insurance. Other loan types like FHA, you might not be able to drop that mortgage insurance. You might have to actually exit the FHA loan and go to conventional loan to get out of it. So be aware of those and ask questions around that. The next thing I'm going to cover is that in your control is your loan to value ratio. So loan to value ratio compares your loan but what you're hoping to borrow against the property. So think about this when you're doing a refinance. If you have more equity in the house, kind of like a down payment, more equity in the house you might be able to get a better interest rate. So if you are going to do a cash out loan, let's say, just think about making sure you kind of find the right balance of how much money you can take out without affecting your interest rate. So for example, it might be better to take out just a couple $1,000s less to get a better interest rate if you're right on the cusp of one of those changes. We call these loan level pricing adjusters. If the loan level pricing adjuster is negative for you, if you borrow just above the loan to value ratio then that actually might impact your interest rate. So keep that in mind as you plan for this, whether you're doing a purchase or a refinance. The other thing that's important is whether you intend to occupy the property or not. So lenders care about whether your home is a primary residence, which means if you're going to be living in the home, or if it's maybe a vacation home or an investment property. Interest rates are usually the lowest on primary residence because you're living in the property. A lot of this money is coming from Fannie Mae, Freddie Mac, Ginnie Mae, which are really government-ish entities that are helping fund housing, and they really like to fund housing for people that are going to live there. Partially is because what happens is it kind of makes the communities more stable, but promotes home ownership overall. And that is one of the reasons why the risk is technically a little bit lower on these. You're going to get better interest rates on primary residence. And if you have a second home or investment property and you have financial issues, let's say, you might be more likely to default on the mortgage, but you don't actually live in the property. And this could theoretically put the lender at risk. So most lenders are going to charge higher interest rates for second homes or investment homes. But bottom line here is both the market and personal factors can affect your mortgage rates. So while you can't do everything to control the market factors and macro economy, you can control your personal factors. Improve your credit score, save for a larger down payment. Worst case, you have a little extra money in the bank. And be sure to take care of what you can control about mortgage rates by looking closely at your personal factors and making sure you're in a best possible situation. Then it will come down to market timing. And I always say, it's really difficult to time the market. It's really about a need and understanding what your needs are. And then if rates do drop, you can always take advantage of that. Thanks again for watching. My name is Kevin Brierton, Certified Mortgage Planning Specialist here at Neo Home Loans and the Kevin Brierton team, your no excuse lender. If you know anybody that's looking to buy, sell, or refinance, friends, family, coworkers, please pass this video along to them or reach out to us. You can go to mortgagestrategycall.com, and we'd be honored to help you out. You can also call or text us at 480-553-8770. Thanks for watching, and we'll catch you on the next one.